comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Hey folks, welcome back to another episode of State Tax Talks. I'm your host, Joe Tantillo, and we have been having an absolutely fascinating discussion on New York's rules for the taxation of partnerships, and again, more specifically, if you've been listening, the rules for the taxation of non-resident partners. I'm joined once again by my colleagues Tim Noonan and Andrew Wright. We're going to pick up the conversation where we left off last time in part 2 of this series. Please enjoy. So let's dive into what will be the meat of this episode, which are the partnership sourcing rules. We've talked about, it's the non-resident partners that are ultimately going to be the resident partners pay taxes. We know that. But the non-resident partners are always the people who are the most curious about what percentage of tax am I going to pay to New York based on the income that I'm getting from the partnership. And that is determined in a couple of ways. We're going to start with, though, the sourcing rules for ordinary income, most basic level. How do we calculate the New York source percentage of ordinary income or loss?
Okay. And there's two ways. So Drew and I will talk about both of them. So the first way, I guess, is it's interesting because I think it's the preferred method in the regulations. It's in the law. Mm-hmm. Like the law just says allocate your sourced income, but the regulations define what that means. And it's interesting because the regulation says that basically the preferred method is this thing called the books and records method. And it's something like if the books and records disclose to the satisfaction of the government that you can delineate your income and losses, then use the books and records, please. Like that's the method that, again, is the preferred method. I mean, most people don't use that. The other method is the three-factor method that Drew's going to talk about in a second. But the books and records method is kind of what it sounds like. Like, do your books show the income that you earned in New York and the income that you earned in other states? There's almost no authority out there as to how this thing is supposed to work. New York's audit guidelines have an example, kind of a simple example. Like you got a law firm with 3 offices, and the New York office generates $100,000 in net income. The Chicago office generates $50,000, and the California office generates $200,000. Okay, we'll do the math there. So you can tell based on the books and records because there's expenses for the New York office, there's people in the New York office, there's segregated expenses in the Illinois office and the California office. So that all makes sense. It's pretty easy. But the idea is if you can figure it out, you don't have to use this, what we're going to find is a pretty arcane 3-factor method for apportioning income. Again, the problem is there's just like kind of the Wild West. There's like not definitive ways to do that. And maybe sometimes that's not a problem. For lawyers, that's a wonderful thing because it gives us different arguments. So, we've had a number of cases where on the 3 factors, like the taxpayer did it one way or the partnership did it one way on the initial filings, that was kind of wrong. But then it gets to us, they're under audit, and we're like, well, wait a second. Yeah, you're right that they did the 3-factor thing wrong, but that's not even the preferred method. Under the preferred books and records method, they should have done it this way. And again, we've had all types of cases. We just had one recently where it was a hedge fund management company, and they had a bunch of people in New York and just a couple guys in Texas. So when you did the 3-factor thing, which we'll talk about, like it was kind of crappy, like they had a pretty high percentage. But we said, well, wait a minute. We got a Texas office. We know that the guys in the Texas office are generating X amount. We got people in the New York office, including a lot of the back office people. They're not really generating much at all. So why can't we use this books and records method to sort of segregate expenses between the 2 offices? And we did like big spreadsheets and had all the expenses allocated between both places. We allocated the revenue as best we could based on kind of whose like book generated the revenue. And we went with it. And the auditors were like, what are you doing? What's this? I'm like, it's the books and records method. It's the one we're supposed to use. But they were like, no, 3-factor. Remember the 3-factor? I'm like, I know, but that's not the preferred method. So we went back and forth, and it was clear like they didn't have a lot of experience going back and forth on these cases. There's not a ton of case law. So again, that sometimes makes it harder for taxpayers. But I guess, again, it's in the simplest scenario, you got 3 offices, you got people segregated. Each office generates their separate receipts. That's fine, and that's a good example in the guidelines, but that's like not reality. So there might be an in-between where you can use this books and records method to find your way to a good allocation, even if it just ends up you find your way and you do it for settlement purposes. I don't see it a lot on tax returns. Like there's even a box on the tax return, I think, which says, did you use the books and records method?
Right.
You check it off. But so it's not really used on an affirmative basis, but it's out there. And again, it's the preferred method.
It's definitely good to be aware of, certainly for those partnership owners out there and their accountants, that you have that as an option. But it sounds labor intensive.
It's tough, yeah. It's tough.
Yeah, and you got to have the right kind of facts for it, right? I mean, in your example, you got 3 different offices, you got people working from them. You can kind of tie the services and the revenue from services and expenses to the offices, but presumably those people are moving about between the offices. Like if I'm in a service business and, I'm based in Texas and I do a lot there, I'm probably coming to New York too. And
Yeah.
I think it starts to become messy if you try to kind of directly assign, revenue and expenses on that basis in more sort of modern service businesses.
Yeah, we had another one where it was small. It was just like a couple people. The main office where like the secretary was New York. The only rent they paid was in New York, but their entire business was like sourcing people and equipment for like construction jobs in Nigeria. Like really just, or somewhere like that, like some place, around on the other side of the world. And all of the revenue was from these Nigerian construction projects or something.
Interesting.
But under the 3-factor formula that we're going to talk about, their allocation percentage was 100%. It's like, well, that's stupid. Like their whole business is out there. You're telling me under this stupid 3-factor method? No. That can't be. So using the books and records method, we said, you know what? We can tell from the books that this money is coming from the re-rental of equipment in Africa and the temporary farming out of employees on projects in Africa. We're not paying you 100%. You're insane. So, I mean, that's, again, situations where something like that could come up.
Very interesting. Very, very good to have awareness of it for, like Drew said, if you have the facts, it could be a beneficial way to approach this, especially in an audit context. But let's talk about the non-preferred but mostly used method of determining your business allocation percentage. So Drew, why don't you tell us what is a business allocation percentage and how does the 3-factor method that Tim has been talking about work into it?
Yeah, so it's a percentage we're going to compute to effectively estimate, right, how much of the income of a partnership should be apportioned to New York State and should be taxable. New York still has a 3-factor test. It's an equally weighted 3-factor test. So we're looking at 3 factors and we're computing a New York percentage for each of them. So New York numbers in numerator, total numbers in denominator. We compute 3 separate percentages, one for property, one for payroll, and one for gross income. And then we average them, right? Three percentages, we add them together, we divide by 3. That gives us an overall percentage. That's the business allocation percentage of the partnership. All of this math done on the partnership return. That percentage then gets computed and ultimately used to apportion the income, reported out to partners, flowed through on K1s. That's the business allocation percentage. So using these 3 factors, property, payroll, and gross income, we compute that percentage.
So it's effectively a proxy for your New York source income.
Yeah, it's an estimated methodology, right? To Tim's point, if we can't directly source it, right, we got to come up with an estimate. This is the methodology that the regulations have had for God knows how long, Tim, years and years and years, right?
Yeah. And historically, we'll talk about the gross income factor, the sales factor that New York uses. That's all sorts of screwed up. But like historically, most states would have had a 3-factor methodology like this. Most don't anymore, but we still use it in New York for partnerships.
Right. So let's talk about each of those 3 factors then. We'll start with the property factor. How does it work? What is it actually measuring?
Yeah. So it's measuring both real and tangible property. and we're looking at where that stuff is, right? So certainly if the business owns real property, owns tangible property, we're looking at the value of that property, how much of it is in New York, how much of it is everywhere, computing the percentage on that basis. For most businesses, they don't own a lot of real property, right? Most businesses that are service businesses, they rent their real property. They rent offices in various locations. New York actually requires, for purposes of computing the property factor, rents paid to be multiplied by 8.
Why 8?
Computing the property factor.
Because it's more than 7.
Why not?
9, Joe. What the hell?
Not 12.
No, 8.
Months of the year.
And so in my experience, right, for most businesses, the property factor is going to be driven largely by the rents paid for, real property in various locations. And, historically, a lot of businesses that had a rental property in New York City paid higher rents in New York City than they did in other places they might have offices. And because of that factor of 8, often resulted in kind of outsized New York property factor.
But you could use personal property, right, if it were beneficial. Let's say I own, I want to say an aviation business, but I know they sometimes have special rules. But let's forget that aviation businesses have special rules. And for sake of the hypothetical, say I have an aviation business with a headquarters in New York, but then I have a hangar in Florida that has a fleet of jets at it.
Yeah,
I could theoretically take the value of all those jets and factor it into the property factor.
Yeah, like the rules require it, right? The rules say we look at both real and tangible property. For most businesses, right? In your example, I've got some really expensive tangible property that kind of exists outside of New York. It could result in some kind of helpful inputs to that fraction for New York purposes. For most businesses, every business has tangible stuff, right? For most of them, when compared to real property owned or rents paid times 8, it becomes a modest portion of the fraction. But even for regular businesses, right? I got we're the Hodgson Russ law firm. We got all the desks we own, and we got all the computers and things that sit in the office, right? We have a lot of tangible stuff that would get included in that property factor as well.
Usually on audit, it doesn't really get into the nitty gritty of things like computers and desks and office inventory, though. It almost always, as you alluded to, is based on commercial rents paid.
Yeah, just from a sheer number standpoint, that's going to drive the calculus for a lot of businesses.
But if you did want to be extremely pedantic, you could go through every single item that your partnership owns. I wouldn't recommend it. It would probably upset the auditors. Okay, so that's the property factor. How about the payroll factor?
Yeah, so payroll is what it sounds like, right? We're looking at the amount of wages we pay to people who are employed by the partnership. I think probably of most importance here, we're only looking at employees, right? So in a lot of closely held businesses, the main people that work for the partnership are the partners. Mm-hmm. Those partners, by definition, are not employees, right? They're not drawing a wage. They don't get payroll. And so they actually don't count in the payroll factor. They will in the gross income factor, which we'll talk about in a minute. But here we're just looking at wages paid to employees, right? And we're generally sourcing that wage based on the office from which the employee works, right? So if I've got an employee based in New York, I'm putting all the wages in numerator and denominator. If I have, in Tim's example, we also have an office in Texas and I got some people working down there, right? I put the wages of those people in the denominator of the fraction, but not in the numerator.
And a couple other things with respect to that. There's no workday aspect of that. Like if you have someone who is based out of the Texas office but works 25% of their time in New York, for income tax purposes, that person might have to allocate or will have to allocate some of their salary to New York, but you don't do that for payroll. Payroll is kind of like an all or nothing thing, person by person, employee by employee. The other thing is, Andrew, I don't know if you've had this come up, but like the whole convenience rule nonsense. I think I podcasted with that last time on the convenience rule, but that's not a thing here. So if you're not connected to the New York office, you might be working remotely in Florida, but you could be not part of the payroll factor if you're a Florida home office employee, even if you might have a convenience rule problem. But I think you could take the position for the purposes of the payroll factor that person is not New York payroll.
Interesting.
Yeah, I mean, I've certainly seen that come up in audit. I think the rub often in audit, right, is if I'm that employee working remotely from Florida for my New York business, presumably the company's withholding New York tax on my wages.
So then that just ports over to the
I mean, I think auditors
Yeah.
would generally say
Use
yes,
that,
right?
yeah.
Well, wait a minute. The company treated those wages as New York wages. They withheld on them. And so why shouldn't those wages be included in the payroll factor? I mean, we've got a couple of cases going now where we're kind of dealing with this issue, right? And certainly for purposes of an audit, we might look at this more closely and say, well, wait a minute, where's that person actually working? I think where I got when I looked at this, Tim, is like, this is a personal income tax regulation too, right? And so I suspect what New York would say is the payroll factors defined in the personal income tax reg. We're defining New York wages, and geez, it doesn't say convenience rule right in the reg, but there is a convenience rule in the regulations more broadly, in the personal income tax regulations. I don't know that I've seen that come to a head though in an audit context.
Yeah, I don't think I
would say.
Yeah, I don't think I've had to fight about it though. And it's funny, like I don't also think I've gotten into many fights over the years on the property and payroll factors.
Right.
It's the other factor that's kind of funky, but
Yeah, they're normally pretty well defined, right? Property and payroll.
Yeah, they're definitely the easier of the three. Before we move on, independent contractors, not part of the payroll factor, correct? It's already been alluded to.
Yeah,
Employees
wages paid to employees, right?
Yeah.
So if I've got third-party contractors, those are people not getting paid a wage, right? If partners who get guaranteed payments, right? Those are not wages for purposes of the payroll factor.
All right. So we've danced around it, but let's talk about the gross income factor and why it is the funkiest, as Tim put it, of the three factors.
Yeah, and maybe just some background first. So I said like before, most jurisdictions historically have had three factors: property, payroll, and what's historically referred to as like the sales factor or the receipts factor. And that's, based on where your sales are. And if you're selling tangible property like sneakers or T-shirts or, widgets, that's based on where they go, where you send the widgets, where they're delivered. And if you're providing services, historically, that was based on where you're performing the services. Over the years, many states, for corporate tax purposes, have migrated basically to customer sourcing for everything, even services. So it was already customer sourcing for stuff if you sold tangible property. But if you sold services, most states, including New York, for corporation purposes, have migrated to looking to where the customers are. And like from a tax policy sort of standpoint, the reason for that is you're kind of screwing over your own New Yorkers if you have this property, payroll, and receipts factor that's based on where you're providing your services, right? It's because you're going to have a property factor because you have a building here. You're going to have a big payroll factor because your employees are here, and you're going to have a big receipts factor because you're performing the services here. So you could be, exporting all of your services outside the state, but New York would be like, oh, cool, we get to tax you on everything. Even if you're like a non-resident, you own part of this business. Based on the three factors, you'd be screwed over. And again, that was the corporate rule as well for ages. The reason to switch to two things: single factor, so get rid of that property and payroll nonsense. We're just going to use a single factor, and to say that we're going to source it based on where your customers are. Well, shoot, now you could like have a big facility in New York and have tons of employees in New York. But you only have to, again, this is like a sourcing, non-resident sourcing thing, but you only have to pay tax in New York based on where your customers are. Well, I'll build my factory in New York then. Why not? I'm not going to get screwed over because I'm going to have all this property and payroll. So from a tax policy perspective, states, I think very smartly migrated to that. And again, it's a way to, make, taxpayers in other states pay your tax. Because if you have a big manufacturing facility in Texas and all your employees in Texas, but you've got all these sales in New York, and New York's going to say, bring it on, Texas company, we get to tax you, even though you don't have any of your crap here. So that's why they sort of migrated to that. New York, New York has migrated corporate-wise, but it's so dumb. Like for partnership purposes, we're still stuck in like the 1960s, like allocation rules. We still got a property factor, we still got a payroll factor, and we have this ridiculous thing called the gross income factor. So the gross income factor says, and I don't have the chapter and verse in front of me, but it's basically you source income from sales based on the office from which they came or something like that. So
Yeah. And I do have.
You
chapter
do.
and verse,
See?
Tim. How
Look,
about
by the way,
this, right?
I didn't know we were allowed to bring notes. I thought this was like contemporaneous. You wanted to be, and Drew's coming in with notes. That's kind of.
Well, because I knew you would need me to back
Thank you.
up with the
What a team.
actual language. I'm
You know
a
what?
team player.
You know what he is? He's a leader. Right?
He
This
is.
guy.
He is.
Yeah,
He
this
is
guy. Yeah.
the piggle.
Yeah. So what does it say?
So actual language, right? Sales made or charges for services by or through an office, branch, or agency of the business in New York over the total of those things. That's the definition of the factor. And that's sentence 1, I think, in the regulation, right? In the definition of the gross income percentage. And then it goes on to, well, how do we now allocate the sales made or charges for service to the New York office or the other offices, right? And so the second part is charges to be allocated to New York State include all sales negotiated or consummated, or charges for services performed by an employee, agent, agency, or independent contractor, chiefly situated at, connected by contract with, or otherwise sent out from offices, branches of the business, or other agencies situated within New York State.
So 3 of us have a partnership. We sell sneakers. We got our facility in New York. We do everything on Zoom remotely in New York, but we're like a provider for this, school in Texas, and we sell most of our sneakers to Texas. Ship them out, boom, they're gone. Our gross income factor is what?
100%.
100%. Even though all of our crap is going to Texas. We've got a payroll factor and a property factor too, but that's weird, right? Just, again, when you think about for services, again, historically, services have also been where you're doing the work, and that, states have migrated to what we call market sourcing and look to where the customers are. But you still have, vestiges of states that use what I guess was historically called cost of performance. So you can look to where the services are performed. That's still a big thing. Like lots of jurisdictions still have that.
Right.
But this idea that if I'm selling sneakers, I also have to allocate it to New York if they're emanating from New York, that's weird. I mean, that is something that I think throws lots of people off.
Yeah, it's a very, very unusual, antiquated rule in, like I always say, like in the Amazon era of, modern technology, modern commerce, to have a rule that physically ties you to a desk and forces you to source your sales to that desk effectively. It really just doesn't make any sense. And from
a tax policy perspective too, why do I have that desk then in New York? Like, you know what I mean? Like I could just put that desk in Florida and now all of a sudden, I can sell sneakers from everywhere and I'm not going to pay any tax in New York. So it's kind of wacky.
And New York's seeing the impact of that in a post-COVID world, right? Because there are lots of businesses who, the tinfoil hat theory, right, is kind of pre-COVID. New York City is the center of the universe. Companies had to have an office there. They had to have their people there, right? That's where business was done. And so this rule is very favorable to New York. But in a post-COVID world, I think a lot of businesses, especially service businesses, have found that's not true. They can, in fact, do what they do from lots of places. And so, if I'm a closely held business, I got, a couple partners and 20, 30 employees, maybe I just pick up my company and move it. And now all of a sudden, I don't have this issue in New York anymore, right? And so from a policy standpoint, I think you would think the tide is turning a little bit in that regard, though I haven't heard any discussion about updating these rules.
No, I don't. I think it comes up a lot because, for S corporations, which are also flow-through entities. Have you had an S corporation podcast yet, Joe?
Not yet, but added to the list.
Okay. Well, that's another form of flow-through entity. You can choose to be an S corporation instead of a partnership or an LLC. You don't have this problem because they use customer-based sourcing for everything. So it is, so anyway, I think it comes up a lot because it's like, hey guys, why don't you get a little consistency going here? And it's just not happening. Maybe they think it's a revenue issue, that they'll lose too much revenue, but I never understand that because sure, you're going to lose revenue from the companies that are here, but what you're going to grab is all the companies who are selling into here.
Yes.
You're going to be able to, tax all those folks who now under the 3-factor rule, they're selling sneakers into New York and they don't have to allocate income because of the stupid gross income factor. So I think in a bigger picture, it would seem to be a revenue raiser.
Yeah, I would think especially with the way things appear to be trending now, President Trump's got the tariffs on with the hopes of increasing American manufacturing and bringing more manufacturing and shipping back to the United States. With that on the horizon and people making things and sending them out to all the states, you would want to attract some of that if you're New York, I would think.
Attract some of that growth and pick up some of the. If other people are manufacturing more in the U.S., selling more to New York, you can now tax them because you don't have this dumb gross income factor that says it's based on the office chiefly situated, yada, yada, yada. It's crazy.
It just results in like certain businesses having to make or at least contemplate strange decisions, right? Like I had this exact conversation last year with a client. They were two-member LLC taxed as a partnership, only office of the business in New York. I think they had like 20 employees or something in New York. Only location, all their employees in New York. But to kind of Tim's point, the market for their services was really all outside of New York. But under New York's test, right, this 3-factor test, they were kind of saddled with 100% BAP. And we thought about it, a bunch of different things, right? I mean, my first suggestion was, well, why not just become an S corporation, right? And there wasn't any kind of legal reason why they couldn't, right? They had U.S. Individual owners. But for other reasons, they decided it didn't make sense. And then it was like, well, geez, why not just move the office and the employees 10 minutes down the road to across the border in Connecticut, right? And so they did, right? And
which uses market sourcing.
Which uses market sourcing. Yeah. And now they have no location in New York and no payroll in New York and no gross income factor because all the services are being rendered from Connecticut, which to Tim's point uses market-based sourcing. So they didn't necessarily want to leave New York, but it became just an easy decision, right?
Yeah, it really becomes quite a simple fix once you're aware of the rules, if you know how it works. Yeah, it baffles me, and it has baffled me since in my short tenure as a SALT attorney, why we would use these rules. They seem outdated, and maybe they'll change, but for now they just create unnecessary complexity and a lot of head scratching on the part of clients and accountants who sometimes are just unaware that these are the rules because they seem so archaic.
And because the other rules have, to Tim's point, all changed, right? So yes. I just fielded a call yesterday from an accountant who was asking these questions, right? It's single factor sales apportionment, right? Drew, for partnerships and we use market-based sourcing? No, it's not, right? It's this other test. And so
all of those things you just said are wrong.
Yeah, there's still tons of confusion out there, right? And I think
I imagine if you're a non-New York-based accountant working with a partnership that is doing business in New York, and all the rules in your state have changed, if you're not actively keeping up on the fact that New York's haven't changed, you might just miss it. Or if you're a young practitioner as well, and every other state that you've learned about has single sales factor, and you're just finding out that New York does something completely different. So it's unusual. Okay, guys, time to pause once again. This brings us to the end of part 2 of our discussion on partnerships and non-resident partners. Thank you to Tim and thank you to Drew for joining us once again. We're going to pick things up in the grand finale next time with part 3 of this series. But until that time, this is State Tax Talks. I'm Joe Tantillo, and we'll see you real soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.